Warren Buffett says that you don't really need brains. What you really need is the right orientation. He points out that 90% of people who buy stocks, I'm not making this up, don't think about them in the right way. Instead, they think about something they hope will go up next week and the market. They get worse if the market declines. If it goes up, they feel better. I consider what the company will be worth in 10 or 20 years, and I hope it goes down when I buy it because I'll buy more inspired by Warren Buffett's investment wisdom. The principles of growth apply to everyone, regardless of starting capital. However, the strategy you choose will vary greatly depending on whether you plan to invest the $750 initially and add to it over time, or if it's a one-time investment. In this video, we're going to introduce an easy 3-step strategy that's not just for the wealthy. It is true that investing, even with a tiny amount like $750, is a wonderful way to start building wealth. However, if your aim is to invest this $750 and then sit back and wait for it to turn into a fortune, we need to reevaluate expectations. However, achieving true riches requires more than simply perseverance. It also requires strategy knowledge and, occasionally, a sober assessment of the potential returns that various investment vehicles might provide. Let's begin with $750 one-time investment alternatives. Regarding the cornerstones of accessibility and financial safety, savings accounts are unique in that they provide both a safe place to keep your money and the opportunity to earn income. However, the reality of savings account yields may eventually cause you to rethink your plans if your goal is to grow your $750 into a sizable nest egg. As of March 15, 2024, the national average yield for savings accounts was reported to be 0.57% APY. This is a small improvement over the historically low rates of prior years, but it's still far from a wealth-building survey, according to a new bank rate survey. Stronghold, let's analyze this. If you invest $750, it will grow to approximately $754.28 over the course of a year. However, if you wait 5 years, the power of compound interest will mean that, assuming no additional contributions, your initial deposit will only reach approximately $764.25. This illustrates a crucial point. Savings accounts offer unparalleled safety and liquidity. However, their rates of return are not intended for accumulating wealth. Your investment's moderate growth over the course of 5 years shows that even with slightly higher interest rates, saving money in a traditional savings account won't make you a wealthy person overnight. Now that we've moved on to the next stop on our financial journey, certificates of deposit, or CDs for short, let's look at the numbers and see what the current landscape looks like. CDs have historically been the go-to option for those looking to earn a little bit more than what a traditional savings account offers without venturing into the volatile world of stock markets. However, the big question remains, can investing your $750 in a CD turn it into a significant sum over time, whereas the APY on 5-year CDs is 1.44%? What happens to your $750 in this situation if you invested in a 1-year CD at 1.78% APY? By year's end, you will have approximately $763.35 if you choose to invest in a 5-year CD at 1.44% APY. After 5 years, your investment grows to about $836. While these are safe, guaranteed returns, they draw attention to the fact that CDs by themselves won't make your $750 into a fortune, even with better rates. The growth is modest, far from transformative wealth. Let's now examine the stock market, which is a more dynamic investment option. 90% of the individuals I work with to solve the error aren't thinking about stocks the proper way. Instead, they're thinking about ones that they hope will rise next week. The stock market is notorious for both its volatility and its potential for large returns. However, what if we were to make an assumption about a hypothetical situation in which you might consistently get a 20% yearly return on your investment? Sounds a little magical, doesn't it? Let's see how your $750 would be affected. Putting $750 into the stock market and earning a 20% yearly return seems like a quick way to get rich. Within a year, your investment would increase to $900. On paper, it looks great, but if you continue this increase for another 5 years, you might end up with about $1,880.96, more than double your initial investment. Though the 20% return is significantly higher than what you would receive from savings accounts or certificates of deposit, CDs. Let's put it into perspective. While turning $750 into nearly $1,900 in just 5 years is impressive, the reality is that consistently achieving such a high return is extremely challenging, even for seasoned investors. The stock market can be unpredictable with many factors influencing returns. The question of whether this is a route to true prosperity is more crucial to ask, and the majority of respondents say that it is not. Although the stock market can be an effective vehicle for generating wealth, relying solely on a $750 investment, even with strong returns, is not likely to make you wealthy. If you have $750 to start with and want to grow your wealth greatly, then where does that leave us? Wealth growth involves a combination of continuous investments, diversity, and time. The secret is to figure out how to increase the initial investment into a bigger amount, which can then be spread across a number of different investment options, such as the stock market. The stock market becomes a more attractive alternative for a portion of your investing strategy once your initial investment has increased, enabling you to benefit from compound interest and potential gains over a longer time frame. Keep in mind that the objective is to establish a sizable portfolio over time by increasing your contributions gradually and making good investments. Let's now explore how concentrating on personal growth and entrepreneurial endeavors might help you actively grow your $750 investment. The renowned Oracle of Omaha, Warren Buffett, advises investing as much on oneself as possible because you are your own greatest asset by far. His right-hand man, Charlie Munger, similarly emphasizes the value of lifelong learning and skill development. Their combined knowledge highlights a potent method for boosting your worth and making money through side gigs. Consider allocating a portion of your $750 to register in a $200 online course covering all aspects of digital marketing. You gain highly sought-after skills from this investment in yourself, and you use these newfound abilities to launch a freelance digital marketing business. In the beginning, you land modest jobs that each bring in an additional $300 a month. In just 3 months, you've not only recovered your initial money, however, you've already begun to bring in a consistent flow of extra cash. So let's take a closer look at the figures after 3 months of course repayment. Every dollar you make from your side business is a direct profit. For example, if you continue to get $300 a month from freelance work, you would have made $3,600 in a year. However, it shows how investing in oneself and beginning a side business can yield a higher return than the meager growth provided by conventional savings accounts or certificates of deposit. However, you've already begun to bring in a consistent flow of extra cash. So let's take a closer look at the figures after 3 months of course repayment. Every dollar you make from your side business is a direct profit. For example, if you continue to get $300 a month from freelance work, you would have made $3,600 in a year. However, it shows how investing in oneself and beginning a side business can yield a higher return than the meager growth provided by conventional savings accounts or certificates of deposit. It also focuses on how you can enhance your earning potential by acquiring in-demand skills and using them to generate additional revenue streams. It's time to think about growing your investment portfolio even further now that you've started actively growing your initial investment and are generating additional income. One appealing option is to explore real estate investment without going the traditional route of buying properties outright. Real estate investment doesn't always necessitate owning physical properties. You can enter the real estate market with as little as $11,000 thanks to the growth of crowdfunding platforms and real estate investment trusts. Using crowdfunding platforms, these cutting-edge investment vehicles let you take part in real estate ventures without requiring a sizable upfront commitment. By pooling resources, you can invest in real estate projects like commercial or residential developments with other investors, giving you access to opportunities that you might not have had otherwise. You can also diversify your investments by spreading your risk across a number of projects, which could increase returns. REITs, on the other hand, provide an additional real estate investment option without the burden of managing properties. These investment trusts use money from a variety of investors to buy, manage, and occasionally finance income-producing properties. As a shareholder, you get to enjoy the growth and rental revenue of the property without having to shoulder the duties of landlordship. By investing in these real estate vehicles, you can diversify your investment portfolio beyond traditional stocks and bonds, potentially enhancing long-term returns and mitigating risk. The next logical step in your investment journey, once you've established recurring funds for investment, is to consider the stock market. Both crowdfunding platforms and REITs offer avenues for passive income through rent and property appreciation. Buffett summed up his opinion in index funds for wealth growth when he famously remarked that for the most majority of investors, a local cost index fund is the most rational equity investment. However, investing in index funds is a smarter option than buying individual stocks because they provide a number of significant benefits that support your financial objectives. I'm not buying stocks. Instead, I'm buying these. This is a largely American business, and I'm happy with it. First off, investing in index funds offers instant diversification. By doing so, you expose yourself to a wide range of stocks, frequently spanning several sectors and industries. This helps spread risk among numerous companies, reducing the impact of any single stock's performance on your overall investment. Since index funds seek to replicate the performance of a particular market index, like the S&P 500, they typically have lower fees than actively managed funds. This is because they require less active management, which results in lower expense ratios and allows you to keep more of your investment returns over time. Additionally, index funds offer simplicity and accessibility, making them suitable for both novice and seasoned investors alike. Lastly, many brokerage platforms offer commission-free trading for index funds, further lowering the barriers to entry and making it easier for you to invest. The majority of actively managed funds have underperformed broad market indexes like the S&P 500 over time, which is perhaps the most significant historical data supporting the long-term success of index fund investing. By aligning your strategy with the market's overall upward trajectory, investing in index funds increases the likelihood of reaching your wealth accumulation goals. All in all, index funds provide cheap costs and diversity, easy accessibility, and a successful track record that you can rely on while you develop your investment portfolio. As you embark on your financial journey to multiply your $750 investment in 2024, keep in mind that the key is informed decision-making and strategic planning. Which investment option resonated with you the most? Are there any strategies you're eager to explore further? Post your ideas in the space provided for comments below, and let's continue the conversation. Allocating funds to index funds can be a strategic move towards long-term financial growth and stability. Following Warren Buffett's principles can be a lucrative strategy for multiplying your wealth in 2024 and beyond. By focusing on long-term investments, staying patient, and continuously educating yourself, you can set yourself up for financial success. Remember, the key is not to chase quick gains, but rather to build a solid foundation for your wealth to grow over time. So start implementing these 3 easy steps today and watch your $750 investment flourish into something remarkable. In conclusion, mastering the art of investing is not about quick fixes or overnight success. It's about adopting a mindset of patience, discipline, and continuous learning. By following the timeless principles of legendary investors like Warren Buffett, you can pave the way for a brighter financial future. Remember, the journey to multiplying your wealth begins with a single step, and these 3 easy steps can serve as your guiding light. As you embark on your investment journey, always keep in mind the importance of staying informed and making well-researched decisions. Don't let fear or uncertainty deter you. Instead, use them as opportunities to grow and refine your strategy. In the realm of investing, there's always something new to discover and learn, regardless of experience level. If you found this video insightful and valuable, we encourage you to like, share, and subscribe to our channel, Investing Tutorial. By doing so, you not only support our efforts to provide quality content, but also join a community of like-minded individuals dedicated to financial literacy and empowerment. Together, we can unlock the doors to financial freedom and build a brighter future for ourselves and generations to come.